welcome back. Today, we are going to talk about central banks and monetary policy. Understanding what central banks are and monetary policy is going to help you do a proper fundamental analysis that'll make you money. I mean, that's why we're here, right? So, what is a central bank? A central bank is the bank of banks, and they operate in an economy as an independent authority. They have control over major functions in an economy, including bank lending. They lend to smaller commercial banks. Banking regulations, they are the ones in charge telling commercial banks what they can and cannot do. They handle the money supply and they manage the foreign reserve. The foreign reserve is actually a very big one that forex traders think about when they think central banks, but central banks do a lot more. And their decisions affect us in many different ways. Most of the economic news you're seeing is usually about something that a central bank did. And all of the major currencies have a central bank. The dollar, the euro, the pound, the Japanese yen, the Swiss franc, all of them have a central bank. Looking at the US, for example, for them, they have the Federal Reserve, or the Fed for shorts. If you see a news article saying Fed says this, Fed says that, or Chairman Jerome Powell says that, he's the one that leads the Federal Reserve and has a lot of influence on the monetary policy of the United States of America. So he uses the Federal Open Market Committee, FOMC minutes, to dictate their directive to the world. So the Bank of England, the European Central Bank of the Eurozone, the Bank of Japan, the Swiss National Bank, they all operate in a similar manner as the Federal Reserve. And one of their primary objectives is to control the money supply. In fact, after demand and supply, the number one powerful force affecting the money supply is the central bank. So they have a lot of tools to do this. One of them being open market operations. What are open market operations? Well, imagine the central bank, imagine the Federal Reserve as a buyer and a seller in a market. This market is the market of government securities. So when the central bank buys government securities like treasury bills, treasury bonds from smaller banks and institutions, these smaller banks and institutions are going to give the central bank like the treasury bonds that they own, and the central bank is going to give them cash. So you see, the central bank is releasing cash into the system, which is going to increase the money supply. On the other hand, when the central bank sells government securities to smaller banks and institutions, what they're doing is soaking up the money, the excess money in the money supply, because they're going to give out the securities and they're going to take cash out of the system from these banks and institutions. Another tool that the central bank has at their disposal is reserve requirements. The central bank can just come out one day and say, oh, the reserve requirements for all these commercial banks is going to be 90%. What that means is that 90% of the deposits in the commercial banks is going to be kept as a reserve. That sounds quite simple, but the magic happens when only 10% can only be lent out. Money is created when it is lent out. And if only 10% of those monies can be lent out, that means that money is not being created, and therefore the money supply is going to shrink. On the other hand, if the central bank says, oh, reserve requirements are now 10%, the commercial bank has a lot more money to release into the system as loans. And you're going to see the money supply balloon, expand. So that's how the central bank uses the reserve requirements. They increase reserve requirements to reduce the money supply, and they decrease reserve requirements to increase the money supply. In the next video, we're going to talk about interest rates and how the central bank uses those to run their money supply manipulations.